Okay, so I'm going to try and whiz through this fairly quickly. Another disclaimer, very important, so we all need to bear that in mind. And then we are in the risk business. Mike had a long list. I toyed with trying to address all 27 risks that he listed, but I've actually come down to around 3 main ones in the end, which we're going to address this evening, which are longevity risk, investment risk, and sequencing risk. And I'm not going to dwell too much in investment risk because we've got 3 experts here to talk about that later on, and then quickly go into a conclusion. Well, you know, you're taking a risk if you cross the road. Obviously, you can do it in a particularly extreme way, as you see on the far right-hand side here, and cross a tightrope between what were the Twin Towers in New York. But any decision that you make in life is, in the end, a risk, and it's how you manage that risk that's particularly important, and it's particularly the case with investment. And as people who are looking to progress through life, you know, we are facing multiple different risks, whether it's the closure of final salary defined benefit schemes, an increased reliance on defined contribution schemes. Pension freedoms give us lots of choice, but with more choice, there's obviously more chance of making a mistake. And I think that probably the biggest issue that we have as we go from defined benefit to defined contribution schemes is we're moving from an era of pooled risk to an era of individual risk, where we all have our own SIPs, our own investment pots, and how we run them is entirely up to us, and according to our own particular needs, goals, appetite for risk, and time horizon. And there are 3, again, particularly large challenges out of that very long list that Mike's pointed out, which, again, I'm going to address now, which are longevity, investment, and this new concept that's becoming increasingly hotly debated of sequencing risk. So possible solutions, and I emphasize the possible because the industry is in many ways still adapting some of these new challenges, as Mike was discussing. So longevity, that, by the way, on the right-hand side is David Tennant. You may be surprised to know from an episode of Doctor Who, looking particularly old. But longevity is a big risk to anybody in retirement and drawdown. As Mike said, you might just outlive your money, which is not really what a pension or an investment pot is all about. And again, Mike's stealing all my lines. One option is an annuity, but there is currently a perception, owing to prevailing low interest rates, that they just don't offer value for money. Now, there are alternatives. Again, the States is in many ways quite a long way ahead of us in this respect. You already have a product over there called a deferred annuity, which perhaps you can buy at 65, and it doesn't kick in until you're 85, say. So again, that's actually a perfect way of insuring yourself against living an awful lot longer than you thought. So that what Mike and I are really looking for is some of the pension providers to start coming up with a few innovations like this. I noticed that Partnership and Just Retirement actually had a rights issue recently, and one of the things they said they would be looking to use the money for would be to develop new products. It's possible that some of these firms feel a bit capital constrained under the new regulatory regime, but that's the sort of thing that might be worth keeping an eye out for as and when they're developed, as one means of insuring yourself against living a little bit longer than you thought, because in the end, that's what an annuity is actually there for. Now, this is another concept, and we're going to touch upon this in a little bit more detail. Yes, you may build a very, very successful investment portfolio, but the big question then is, how much do you feel safe withdrawing on an annual basis without depleting your pot too quickly? Now, this chap, again, another American, I believe, Mr. Bengen, suggested that 4% per annum was about the right number, and that's actually become known as SAFEMAX. Now, that has actually come under some question recently, partly because returns on cash are at record lows, bond yields are currently very, very depressed, and it's getting harder and harder to find a fairly safe level of income. And people have begun to refine this. So you've got Mr. Pfau here saying that around 3.8% per annum as a withdrawal figure now may be right, but you also have a very active debate here about what's the optimal mix. And we had these 3 gentlemen here saying it was roughly 50-50 bonds and equities, gave you a 95% chance of funding a 4% SAFEMAX limit over the lifetime over the period of your retirement. Now, these are Pfau's SAFEMAX assumptions for this 3.8% figure. I won't go through them in great detail, but as you can see, there is still, the more money you want to take out, the greater the risk of failure is, the greater that your money runs out. But again, it all depends, as you can see, I mean, you've seen the number of disclaimers already. These are Pfau disclaimers. Requires perfect market foresight and timing. Well, we'll leave that to Jeremy and Catherine and Robert later on. 50-50 UK equity bond allocation, global equity allocation, 30-year time horizon, no administration fees. Sorry, Charles, where are you? There you go. annual inflation, annual inflation adjustments were made, thankfully, and there's an annual rebalancing in there. So lots and lots and lots of assumptions, and that's the number they came to. But as you can see, even with all that lot, there's still a chance that something can go wrong. So we're still continuing to refine the different strategies that are available to you. That, on the face of it, academically, not a bad one. So as a starting point, something nice and simple like that might be worth doing either yourself or by turning to the experts who are sat here later on. And again, but you still need to think about how much do you actually want to start taking out and how safe do you feel doing so. Now, if you want to do this yourself, we're now moving on to investment risk. And Mike mentioned behavioral risk as one of his. This is bound up in this. This is Charlie Munger, Warren Buffett's sidekick. And one of the most difficult things about investment is that the human brain is hot-wired in a manner that isn't really suitable for investing your money. In some ways, when you want to be buying securities, is at the point of maximum fear, maximum distress, because that's where they're cheapest. But clearly, your brain is, generally speaking, hot-wired to think, actually, I want to run away from trouble, not towards it. Generally speaking, because you'd get eaten by a saber-toothed tiger or something previously. So the brain is actually hot-wired to follow the herd, because that's when you're at your safest, which generally means you tend to see things like this. People who follow the herd tend to buy here, sell here, with cataclysmic consequences for their portfolio. So investment returns are then extremely poor. And you're fighting every instinct that you have. Fear of missing out and greed up here. Fear of losing even more money than you have already, and therefore you tend to panic out at the bottom. And everybody does it. It's just you. I'm sure Jeremy will tell me that he doesn't later. But it's very, very difficult to fight those instincts. And that, as an investment, somebody running your own investments, is something that you're constantly fighting. You're not just fighting the markets. You're not just doing your research, but you're also fighting yourself. The FCA is increasingly all over this issue of behavioral risk and behavioral biases. This is a very, very big one. And unfortunately, if you do want to run your own money, it's not easy to do, and this is one of the reasons why. It's just the way the chemicals inside you work. So, and that sort of cycle here, which is from my good colleagues at Shares magazine, Dan Coatsworth, the editor, put that together, is why you tend to get things like this, which is the FTSE All-Share. Now, over time, if you think about it, a 3% move in the UK economy is a really, really big deal. Yeah, 5% down in 2009 felt horrendous. A 5% move in a share price, most of you wouldn't even flinch. Why? Well, why do you get this? Because you get the gearing effect. You get GDP growth. That has a gearing effect on earnings growth. And then if that's the E in the PE, in the valuation, the P in the PE, the price that people want to pay to access that growth, that's what you're responsible for. Getting all greedy and excited at the top and panicking out at the bottom. So you get a huge gearing effect of economy, corporate earnings, greed and fear. And that's why markets swing around as they do effectively. And so this will always happen. And it's very, very difficult for people to manage, particularly when you're doing it at home and you're tired and it's late at night after a long day at work. But if there is one very simple rule, and again, Charles, who's my boss, will look daggers at me now, investors should remember that excitement and expenses are their enemies. This is a patient, long-term game. If they're used properly and they work for you, financial markets are get-rich-slow schemes. They are not get-rich-quick schemes. And so, again, if you're going to try and be greedy, the times to do it are ideally here and here. And if you're going to be fearful, these are probably the times to be fearful, but your brain tends to think the other way around. So if all this is just too much for you, that's why investment experts are here, and you'll get to listen to them later on. And again, these are the things that they're paid to conquer and look at things in a very dispassionate way. So when it comes to do's and don'ts with choosing a stock, choosing a fund, an investment trust, or an ETF, again, as Mike said, you've got to have a clear plan. You've got to have your own style. You've got to take a 3D view. Particularly when it comes to stocks, most people are obsessed with growth. I want a company that's growing. Fine. Fred Goodwin grew the Royal Bank of Scotland. What was the result? He drummed the company into the ground because the quality of growth he was generating was extremely risky. It was acquisitive. It was funded with debt. Glencore is another example. Yes, it grew, but it bought Xstrata, bought it with debt, and now it's a very, very volatile company with a very geared balance sheet. Focus on cash flow and dividends, and again, focus on valuation because that gives you the downside protection when things go wrong. That's, if you can pick things up cheaply, that will give you some protection. Whereas if you buy a social media stock that's not earning any money, but it's got a multi-billion-dollar market cap, things start to go wrong there. There's just, it's like Wile E. Coyote in the cartoons. There's just fresh air below you when things start to go wrong. Don't overtrade and rack up unnecessary expenses. In the end, it comes out of your SIP into my kid's Lego collection. Think of it in those terms, and it might just make you think twice when it comes to overtrade. It's just going to end up inside my Hoover. So it should still be in your pension. Don't chase reward forgetting about risk. All the best investors focus about this first and reward second, and don't be impatient. Do be patient. And why should you be patient? Again, we'll come back to this in a minute. This is the simple theory. This is the FTSE All Share, cash, and the without dividends, FTSE All Share with dividends, and then cash, compounded back to 1964, just at the compound annual growth rate returns that we've seen. And as you can see, cash, partly because the UK interest rates were in the high teens here, has actually outperformed the FTSE All Share without dividends. The FTSE All Share gets very, very exciting once you reinvest those dividends over time, and that's when you get the power of compounding working for you. Now, that is without tax, it's without fees, but it does prove the point that if you focus on cash-generative companies that pay dividends and reinvest in them, you've got more of a chance of letting this work in your favor over the very, very long term. But this, again, is the dream scenario of the return is the same every single year. That clearly isn't going to be the case. We'll touch on that in a second. Now, I'm going to step back here, and again, time is already running against me, so I'm going to let the experts talk about collectives, but clearly there are lots and lots of options here to help you make the right investment decisions, or at least build a portfolio that suits your particular requirements. But there are also new things coming along as well, which is going to touch about a little bit and leave the existing products to the experts. Target date funds are one thing. In some ways, they're just a simple version, or a new version of the rule of 100. How did you used to build a portfolio? Well, you subtracted your current age from 100, and that was the percentage of your portfolio you put in equities. Because as you got older, you sort of launched upon a glide path, de-risked your portfolio, and moved towards stodgy things like bonds and cash, so that if there was a market accident, you had some ballast in your portfolio to provide you with some protection. One of the slight problems we have here is that some people now view bonds as being horrendously overvalued. And so that's one of the challenges that we've got, and we'll come back to shortly, because, again, the yields are so low. But target date funds, they're massive in the States, $700 billion under administration, although the total US mutual fund industry is $16 trillion, so there's a lot of room for them to go for. But what they do is they basically operate this in a very mechanistic manner. You put your money into the pot, it has a target date, say 2046 to 2050, and will just gradually, automatically allocate your money away from equities and presumably towards bonds. They tend to do it through as a fund of fund. There obviously you need to check out things like entry fees, management fees, early encashment and performance, but they're definitely gathering interest as a way of hopefully taking some of the stress out of this very important question of asset allocation. This is an Architath's Birth Star target date fund that you can get in the UK. These bars on the left are the current asset allocations. The bars on the right are what you'll have by 2046. And as you can see, very heavy equity weightings here, and then over by 2046 to 50, much more exposure to bonds as the portfolio eases away from higher risk equities to what are, in theory, and I stress in theory, lower risk instruments like bonds. Now, we looked at that earlier example of how clever we all are. Buy stocks like Warren Buffett, park them away, and in 30 years' time, we're all multimillionaires. Well, you can stick to the theory, pick the companies that are economic moats, economic castles surrounded by unbreachable moats, and it can still actually go wrong because of sequencing risk. There's a brand new paper just come out from a guy called Abraham Okosanya, who works for Finalytic, and he's explained it brilliantly, far better than I could. So I've given him full credit and nicked his example. This is a lady who goes to a financial advisor with just over 300 grand. She wants to basically take out £15,000 a year. And the financial advisor absolutely nails it. Bang on. He says, right, we're going to build a portfolio and we'll deliver you 3.8% a year. Remember the SAFEMAX number that we talked about earlier on? And lo and behold, this portfolio delivers exactly 3.8% a year over time. And this lady, by the time she's 90, she retires at 65. By the time she's 91, she's still got nearly 150 grand left. Perfect. Job done. Advisor's done his job. Nicely balanced portfolio, not too much risk. Didn't promise the earth, delivered it. Brilliant. The next chart is sequencing risk, because we still get from here to here, over that third 26-year period, a 3.8% compound return. But we just don't happen to get 3.8% a year. We get what stock markets do. And this lady on this occasion, she starts off with a year that's down about 17%. And then she has a year which is down about 10. And then, okay, there's a big recovery at the end, but the damage is done. By the time she's 81, she's skint. She's run out of money. That's sequencing risk. And you've done everything right. You've still got your 3.8% return a year over 30-odd years, but it's happened a little bit like Eric Morecambe playing the piano in completely the wrong order. And that is sequencing risk. Now, target date funds, in theory, will try and protect you from that, but not necessarily that well. So you're now seeing fresh developments in the States from a company called GMO. They, at the moment, think that bonds are extremely expensive and, if anything, even more dangerous than equities. So what they've actually introduced is a target date fund with this red section here, which is an algorithm which actually dynamically allocates assets according to valuation. Because they say we don't want to automatically put money into bonds at a time when we just think they're really, really expensive. Or we may actually be able to benefit from a major correction in equities and put money in there at the same time. So you'll see the normal glide path. The dark grey is the equity percentage going down. The light grey is the fixed income section going up. But the red bit is in some ways the secret sauce. Now, you certainly haven't got this in the UK yet. It'll be interesting to see if it comes from the States. It'll go over from the States. But again, it all shows, in their opinion, the magic of valuation. Now, US stocks, Professor Shiller of Yale thinks that they're extremely expensive, trading at 24 times trend earnings right now, a figure only exceeded by 1929 and 2000, not years that will live in the memory of too many investors, or if they do, only for the very wrong reasons. And GMO are big Shiller disciples. They think US stocks are very, very expensive. And they would argue that, okay, Shiller, the knock on Shiller, it's not a timing tool. He's been arguing that US stocks are overvalued for about a decade. And so you could argue he's got some egg on his face because they've generally done pretty well. But GMA will counter to that by saying, but look, based on their historic regression analysis, if you buy the US when Shiller is the multiples between 5 and 13, that's what you get on average return long-term from US stocks, over 10%. If you bought historically when the multiples between 20 and 48 times over the next 10 years, you can pretty much guarantee you're going to get that. So yes, in terms of a 1 or 3 year timing pattern, Shiller's not much use, but they're convinced on a 10-year view, it's incredibly useful. And this is from a GMO and also an American guy called John Hussman, looking at the S&P 500, and it shows a fairly similar thing, this time in terms of your downside protection. What goes wrong when you buy into the market when it's at its most expensive? When the market's at its cheapest on the left-hand side, yes, you get a drawdown, but it's maybe only 12 or 15%. On the right-hand side, you can get some absolutely horrendous results because you've piled into the market at the wrong time. So the GMO algorithm is there to try and protect you from that, get you into assets when they're cheap, and avoid them when they're expensive. A further wrinkle, or something else to think about, Mike touched on it, is modern retirement theory, where they argue we're all obsessed with the wrong thing. We're all obsessed with size of pot, when actually what we should be looking for is bringing in income that simply matches the liabilities that we know we have, whether it's the daughter's car at university, whether it's a mortgage, whether it's healthcare, whatever it is. You don't worry about the size of the pot, which I know, again, runs contra to everything that we think, oh my God, my portfolio's gone down. But if you've got enough money coming in to pay life's basics, pay your contingency fund, and even a little bit of a fund, you don't need to worry. And clearly we've got OICs, we've got an OIC here, we've got OICs here, we've got investment trusts that pay semi-annual or quarterly dividends. There's even some investment trusts that now pay monthly dividends, so that you can actually look at the instruments, and as long as you're convinced that they're soundly run and that they will deliver the coupons or the dividends on time, you can actually time those investments, time those cash inflows to meet your liabilities and not have to stress too much about, is the portfolio up or down this month, so long as you know what cash flow is coming in. So it is, in the end, as Mike said, and you'd have thought we'd almost talked about this, wouldn't you, about cash flow planning and managing risks. 3 particular risks. They're all interlinked: longevity, investment, and sequencing. There's no right answer. The right answers will, again, depend on your personal financial circumstances, your investment goals, your time horizon, your appetite for risk, but it will in the end come down to these three options are largely the ones that you've got. Draw down from your capital, rake off the income, or even try and leave it alone and hope that you can keep it growing either on your own or with the help of a professional. And yeah, individual stocks, bonds, and well-run collectives, passive or active, can help you build that portfolio and meet all of your requirements, or at least fit with all your needs. And then, yeah, there may be some new products coming along the line, and I suspect there probably will be, but clearly one thing that we will need to think about then is perhaps how much they're going to cost, but there may be some new things to help us all along the way. So that was a bit of a whirlwind tour, but I just got there before the time up sign went. So thank you very much indeed for your time, and I look forward to taking your questions later on.